Jeff, why the change in the bond sentiment this week, and does it continue?
Yeah, this is not really just directed only at the U.S. market, but this is more of a global phenomenon we've seen this week. As we've seen just more ugly pressures mount within the Eurozone. You're getting more reports of high inflation there. We know producer price indices are going off the charts, screaming just elevated levels. And just the amount of gas that's being allocated from Russia into the Eurozone is causing a lot of problems. And so what that means is it's more stagflation fears that are driving that area. So when you look at the bond rally you've seen this week, it was really incited by global bond yields and not necessarily just the U.S. And so you look at, for instance, the German 10-year has moved in about 13 basis points or so this week. It's somewhat commensurate with what we've also seen here in the U.S. And so I don't think it's something that it's the inflation reports or a change in sentiment at the Fed. This is simply kind of a global growth scare that led to a rally this week in rates. And you're seeing it kind of reverse today.
So it sounds like you're not convinced that rates have stabilized here or that this is the start of a new trend.
No, unfortunately not for bond investors. And I think you got to remain vigilant here, because what we also saw during this was we really saw some cracks within some of the darling childs of the credit market thus far this week. And so things like floating rate loans, which had been immune to the pain within the fixed income marketplace year to date. We saw some really soft trading in those names, really sloppy trading, but in somewhat an orderly manner. So it doesn't look like it's going to cause any long-term pain right now. But also, when you look at the triple Cs, the lowest rated cohort within high-yield corporates, you really started to see a lot of pain in the last couple of weeks. By the way, the high-yield corporate market has had a tough time with issuance as well for the last couple of weeks. So there's some signs out there that look like there may be some, yes, exactly, maybe some issues there. But also remember, too, in hot inflation, we got CPI. We also got PPI, which tends to lead CPI inflation as well. And both of those things still have very elevated readings. So I don't think that the worst in the bond route is still behind us. But I do think we were oversold. You can see some of these conditions here. So potentially we're a little range bound before we look for new direction.
Bob, so I think you agree with Jeff on the bond move. What does it all mean for stocks? We're getting a nice bond bounce today. Every sector is higher. Is it technical conditions, and you see this as a sort of tradable rally?
Yes, yes, and yes. Meaning, I agree. What Jeff just said, bonds have led the way, and stocks needed bonds to calm down to have a chance to rally. You add on top of that less bad COVID news out of China, the sentiment numbers, which are screaming for a buy, some of the other technicals that you referenced. These are the kinds of things that have ganged up to cause this rally, which has been pretty so far.
But I think, Bob, you have liked in the past, I was looking at some of your previous appearances on CNBC, and you've liked Megacap tech, right? Names like Google and Alphabet, which have joined the sell-off pretty intensely this week. It hasn't been great, at least as a short-term call. Do you still stick with that group?
We haven't owned those stocks, and we've been underweight them and short them for some time. The only mega-cap tech stock that we're overweight is Microsoft, and crossing our fingers on that, underweight the others. I'd rather in tech,
so
Sarah,
you got out
play
of them.
old tech. Yes, would rather play old tech, the Intel, Cisco's, IBM's. They're cheaper, they're shorter duration stocks. I don't know that I marry them forever, but renting them now is okay.